Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
We saw that when it came to the historically high hiking of interest rates, that it took some time for that to be felt in the economy. And indeed, it did not slow the economy for some time, and it took a long time for it to slow the pace of inflation. So there was a suggestion that what is in the mechanism of the economy that is therefore acting as a brake on what would normally be a fairly effective cause and effect of monetary policy. In the case of interest rates, what acted as the brake was the fact that there were many mortgages that were already locked in. There were perhaps some companies that did not need to necessarily depend on financing. They had stronger balance sheets, stronger cash. They could put off borrowing. And there was also the private credit market that they could rely on, even though that also would have been related to interest rates. So there wasn't that same necessary effect on consumers. And also certain consumers didn't own property anyway, so they wouldn't have necessarily been affected by the ability to pay their mortgage if their mortgage was going to be adjustable. That was more a direct effect in the UK, where most mortgages were shorter term and not fixed for as long as they are in the US. So if we can then accept that the transmission effect of many traditional instruments of policy is not necessarily direct, why did we assume that the effect of tariffs will be direct? Why did we assume that it would immediately translate into higher prices and that it would essentially act as to choke off global trade? What we saw in the aftermath of tariffs was a lot of preempting of the effect of tariffs and essentially importing in advance of those tariffs taking effect. That was attributable to a massive surge in imports in the first quarter of 2025. We also saw inventories build at that time. And then there was a subsequently reduction in imports. And we saw that in the last GDP print for the US, which did distort the GDP number slightly because they had perhaps been all front loaded at the beginning of the year. So that may have been a reason why there hasn't been that instantaneous effect of tariffs. We also know that many companies were themselves absorbing the impact of tariffs. And that was something that indeed the president had endorsed and had expected companies such as Walmart to do. So we know that many small and mid-cap companies, even though they didn't have necessarily the balance sheet strength that some of the larger companies would have, did still have the ability to absorb tariffs. And they did not pass it through to consumers, the consumers that were already flinching from particularly high inflation.